I don't think it's quite as the press have been saying, the idea that people in America are wanting to stack gold before, 25% tariffs are introduced or whatever. I think if you look at the stands to delivery, which basically is the process whereby on COMEX, instead of closing out a futures position by selling out a long position or buying out a short position, the owner of a long position decides to take delivery. In other words, what he does, he stands for delivery, but he doesn't actually take delivery. What happens is that it gets reallocated within the bullion bank's vault position, whether it's Goldman Sachs or JP Morgan or whatever, that there is, however much gold you stood for delivery, you get a certificate from them saying that, we're holding this on your behalf. So it's rather like an unallocated account, if you like. And the problem always with derivatives, and particularly with gold and silver derivatives, is that derivatives are credit markets, whereas the physical metals are not. I mean, they are delivery markets. And the point about a credit market is that you want to deal in credit. You don't want ever to have to deliver anything. Over the last 4 years, when I started collecting these statistics, the stands for delivery on COMEX have amounted to over 2,100 tons. In fact, including this year, the pace has accelerated since January the 1st, to the point where the stands for delivery this year, if it continues at this pace, will be over 2,000 tons this year alone. So You can see that this is becoming a problem. Now, from the bullion bank's point of view, they have these commitments, and these commitments are probably turning sort of rather real, because it's not just the stand for delivery process, but people are actually beginning to say, hold on, we actually want to submit this certificate in return for our gold. Please, can you deliver it to us? And so this is. This is an increasing problem. And I think the point about the Trump presidency is that nobody outside America basically trusts Trump. They see him as unpredictable. They see the whole thing as, the decline, if you like, the political decline of America. They're uncertain about tariff policies. Basically, they see America screwing up the world. I think that's probably a reasonable description for the average view of the foreigner, you, me, everybody else.
In recent years, the global gold and silver markets have experienced significant shifts, underscoring the enduring value of these precious metals. Alasdair Macleod, a prominent financial analyst, has provided insights into these developments, particularly focusing on the dynamics within the COMEX, Commodity Exchange Inc., and the increasing industrial demand for silver. The COMEX serves as a primary marketplace for trading gold and silver futures contracts. Traditionally, many investors settle these contracts in cash rather than opting for physical delivery of the metals. However, recent trends indicate a growing number of investors standing for delivery, signaling a preference for tangible assets over paper claims. Over the past 4 years, the cumulative stands for delivery on the COMEX have surpassed 2,100 tons. Notably, since January 1st of this year, the pace has accelerated, with projections suggesting that stands for delivery could exceed 2,000 tons by year-end. This surge reflects a shifting sentiment among investors, possibly driven by geopolitical uncertainties and concerns about the stability of fiat currencies. Gold money. This trend poses challenges for bullion banks, which facilitate these transactions. As more investors request physical delivery, banks face increased pressure to fulfill these obligations. Instances have been reported where obtaining physical silver from COMEX vaults, a process typically settled within 5 days, has extended to 9 months. Such delays raise concerns about the availability of physical metal and the potential overextension of paper contracts relative to actual reserves. Geopolitical factors, such as potential tariffs, have further influenced gold movements. For instance, fears of U.S. import tariffs led to a substantial transfer of gold from London's vaults to New York's COMEX warehouses. This migration resulted in a liquidity crunch in London, traditionally a major gold trading hub, causing delivery delays and increased borrowing from central bank reserves. Such shifts highlight the intricate interplay between policy decisions and global gold logistics. Beyond its monetary value, silver plays a crucial role in various industrial applications, notably in the photovoltaic PV solar industry. The metal's exceptional conductivity and durability make it indispensable for manufacturing solar panels. In 2023, the PV sector consumed approximately 193.5 million ounces of silver, marking a 64% increase from the previous year. This surge underscores silver's pivotal position in the transition to renewable energy sources. Projections indicate that by 2030, demand for silver in solar PV manufacturing could account for over 30% of total global silver production, up from about 10% today. This anticipated growth, coupled with the lengthy development timelines for new mining projects, raises concerns about potential supply shortages and cost escalations. International Energy Agency. The convergence of heightened delivery demands on the COMEX and escalating industrial consumption paints a complex picture for the silver market. Investors are advised to monitor these developments closely, as they could influence silver's price dynamics and availability. The dual demand from both investment and industrial sectors may lead to tighter supplies, potentially driving prices higher. In the light of these trends, individuals and institutions alike should assess their exposure to silver, considering both its investment potential and its critical role in burgeoning industries like renewable energy. Diversifying portfolios to include physical silver holdings or shares in silver mining companies could serve as a strategic hedge against market volatility and supply constraints. Macleod also draws attention to the opaque nature of gold leasing practices. Over the past several decades, central banks have engaged in leasing gold to bullion banks at minimal interest rates. These banks, in turn, sold the leased gold into the market, investing the proceeds into higher-yielding assets like U.S. Treasuries. While this strategy appeared profitable during periods of high interest rates, it has led to a significant depletion of physical gold reserves. The leased gold, once sold into the market, is challenging to recover, effectively transforming tangible assets into paper claims. This practice has raised concerns about the actual volume of physical gold remaining in central bank vaults, with some estimates suggesting substantial discrepancies between reported and actual holdings. The implications of these gold leasing practices are profound. They have introduced a layer of complexity and risk into the financial system, particularly concerning the rehypothecation of gold, where the same gold asset is used as collateral for multiple loans. This multi-layered leveraging amplifies systemic risk, especially if multiple claims are made on the same asset during a financial crisis.
So on that basis, if are you still going to be happy, let's say with a certificate from JP Morgan saying, don't worry, we've got your gold, don't worry. Here's a piece of paper which says that we have. So you can see that on the margin, there's a tendency to try and take this gold out. Interestingly, Garter, the Gold Antitrust Action Group, posted a very, very interesting, it was actually on X, Twitter, by a guy who used to work for Sprott, one of the dealers there. And he recounted the process of trying to get silver out of the COMEX vaults. Now, something that was meant to be a 5-day settlement took 9 months. 9 months. I mean, and, he said they took legal advice on this, and the legal advice was, well, I don't think this is something we can pursue. What do you want to do? Do you want to, whatever. I mean, they came up with whatever reason. But I think the real reason, actually, was unstated. And that is, if you forced delivery, in those days, if you forced delivery on the futures system, you would be blacklisted, blackballed. You would not have access to that market in future because the bullion banks would say, sorry, we're not dealing with you. So you've got this sort of, it's rather like a mafia, if you like, in the sense that it's being run by the bullion banks under their terms, and you do not contradict those terms. But of course, a foreigner, who's may be sort of accessed. I mean, if you look at silver, for example, you could have someone like Reliance Industries, which is a big Indian consortium, which is building massive factories for producing photovoltaic cells. How do they get hold of their silver? Well, I mean, one way of doing it is go into COMEX, buy futures, which may be coming next to expiry. And if it's not too much of a premium over spot, then buy it and stand for delivery. And not only stand for delivery, but take delivery. So you can see that how, foreigners, I mean, they couldn't give a damn about, whether they're going to get blackballed by the bullion banking system. It's a Western system in decline for most of the Asians.
The increasing instability in global financial markets is reinforcing the role of gold and silver as critical assets for both investors and central banks. While the first part of this discussion focused on the manipulation of paper markets and rising delivery demands, the second part explores the broader implications of these market shifts, the geopolitical consequences of gold revaluation, and how silver's industrial demand could drive its next major breakout. A notable shift is happening within the COMEX system, where traders are increasingly demanding physical delivery of gold rather than settling in cash. This is creating enormous strain on bullion banks, which have historically relied on a fractional reserve system to manage their gold holdings. As more market participants insist on physical delivery, the entire system is being forced to adjust. The underlying issue is that the paper gold market far exceeds the actual physical supply of gold, meaning that if even a small percentage of investors demand delivery, a crisis could unfold. This is already starting to manifest, with delivery times extending far beyond normal settlement periods. One of the most revealing indicators of the growing gold shortage is the massive transfer of gold from vaults in Europe to the United States. Recent reports indicate that fears of upcoming U.S. tariffs on gold imports led to an unprecedented movement of gold from one major financial hub to another. This has triggered a liquidity crisis in key European trading centers, where gold has historically been held in large quantities. With central banks and institutional investors competing to secure physical gold, those who hesitate to act may soon find themselves unable to obtain it at reasonable prices. The financial system is not just facing economic challenges, it is also undergoing a geopolitical transformation. The US dollar has dominated global trade and finance for decades, largely because of its reserve currency status. This has allowed the United States to print massive amounts of money, finance huge deficits, and maintain economic dominance. However, a growing number of nations are now challenging this system by moving toward gold-backed trade agreements and alternative financial structures. As central banks continue to accumulate gold, there is speculation that certain nations may attempt to formally introduce a gold-backed trading system. This would allow countries to conduct transactions in gold instead of dollars, effectively undermining the current global financial order. The demand for a stable, apolitical store of value is driving countries like China, Russia, and India to stockpile gold at record levels. These nations are positioning themselves for a future where gold plays a much larger role in international trade and finance. One of the key factors behind this move is the weaponization of the US dollar. Economic sanctions, trade restrictions, and political tensions have led many nations to seek alternatives to a dollar-based system. When a currency is used as a tool of political influence, other countries begin looking for ways to avoid being dependent on it. Gold provides that alternative because it is recognized globally, not tied to any single country, and cannot be devalued by monetary policy decisions. While much of the focus remains on gold, silver is quietly emerging as an even more compelling investment opportunity. Unlike gold, which is primarily used for financial and investment purposes, silver has a critical role in industry. It is a necessary component in solar panels, electric vehicles, medical technology, and advanced electronics. This means that silver's value is not just determined by investor sentiment, but also by industrial demand that is growing at an accelerating pace. The rapid expansion of solar energy and electric vehicle production is creating a significant supply-demand imbalance in the silver market. Recent estimates indicate that the photovoltaic solar industry alone could account for over 30% of total global silver production by 2030. This would represent a major increase from today's levels and could lead to supply shortages that push prices dramatically higher. Adding to this equation is the fact that silver mining production has struggled to keep up with demand. Unlike gold, which is mostly recycled and retained in storage, Silver is often consumed in industrial applications without being recovered. This makes it more vulnerable to shortages, especially as industries continue increasing their reliance on it. The gold-to-silver ratio, which currently sits at historically high levels, suggests that silver is significantly undervalued. The historical average for this ratio is around 50-1, but today it exceeds 80-1, meaning that silver prices could have a long way to rise in order to return to equilibrium. Analysts tracking supply constraints and industrial trends are already predicting that silver could be one of the best-performing assets of the next decade. The shifts we are witnessing in gold and silver markets are not isolated. They are part of a broader transformation in the global financial system. As more investors and institutions realize that the current monetary order is unsustainable, there is a growing urgency to secure tangible, real assets before the financial reset fully unfolds. One of the biggest concerns among gold and silver investors is the possibility of government intervention. Historically, when financial crises have escalated, governments have attempted to seize, tax, or restrict access to gold. The 1933 gold confiscation order in the United States is a stark reminder that in times of economic distress, governments may resort to drastic measures to maintain control over monetary policy. While a direct confiscation of gold in today's world is unlikely, governments could attempt to impose windfall taxes on gold profits, restrict transactions, or heavily regulate private ownership. These potential risks make it even more critical for investors to secure physical gold and silver before further restrictions are introduced. While ETFs and futures contracts provide exposure to price movements, they do not offer the same level of protection as holding actual metal. Many investors have already encountered difficulties withdrawing physical metal from vaults, experiencing long delays that suggest supply constraints are becoming more severe. The movement toward gold-backed financial systems, the rise of industrial silver demand, and the increasing strain on physical delivery mechanisms all point to one conclusion. Gold and silver are no longer just investments, they are necessities. The monetary system is being reshaped, and those who recognize these shifts early will be the ones who preserve their wealth and emerge stronger in the new financial era. The suppression of gold and silver prices through paper derivatives and central bank interventions is becoming more difficult to sustain. As demand for physical bullion increases, a major revaluation is inevitable. Investors and nations are taking strategic positions now, accumulating these metals while they remain accessible. As inflation continues to erode the purchasing power of fiat money and global confidence in central banking declines, gold and silver will once again prove to be the only truly stable forms of wealth. Those who act today will be positioned to thrive in the next financial era, while those who remain dependent on the current fiat system may find themselves struggling to maintain purchasing power. The time to prepare is now. Gold and silver are not relics of the past. They are the future of financial stability.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.